Valens Research, Uniform Financial Analytics.
So for Oracle, you'll see here you come to the page that you always come to always first when you're on the Valens Research app, because we think it's central to look at uniform accounting data, which is our performance and valuation prime page. Really quickly, I'm just going to turn on something so we can really understand the power of the uniform accounting by comparing it to the distorted as reported metrics. What I just did there was I turned on this uniform accounting data set to also show as reported metrics. So the performance and valuation prime page, where you always come first when you're looking at uniform accounting insights, is specifically, again, a literal name for what it is that we do. We call it performance and valuation prime because we look at first performance in terms of the company's ability to generate profitability and its ability to reinvest in its business in terms of return on assets and asset growth. And then we look at valuations in terms of the company's outlook in terms of values relative to its asset base and its value relative to its earnings base. Right? Basically, a cleaned up price to book and a cleaned up price to earnings ratio. And then we also look at how its performance has led to its stock performance. And so we can see here first with Oracle is something jumps out immediately with Oracle. And that is these orange bars, the distorted as reported metrics for Oracle, would tell you that Oracle is a 8% ROA business that's been declining over the last 8 years or so. In reality, when we use the uniform accounting data, what we can see is, while that decline isn't unreasonable, in reality, this company is a 30% ROA business. I mean, it is 4.5 times higher profitable than the market realizes for people who are looking at distorted as reported metrics. The next thing that we look at, is around asset growth. Understanding, is the company really reinvesting in the business or not? And look at this, this is crazy. In the last 2 years, you'd have directionally incorrectly understood whether or not Oracle is reinvesting in its business or not reinvesting in its business if you looked at as reported metrics. You would see massively positive, decently positive growth in 2020 when it barely grew at all, and you would have seen it shrinking in 2019 by 20%, when in reality it actually grew by 5%. Right? This is a totally different understanding of what this business's profitability is and its growth strategy is for the business that you can only see when you look at the real numbers. And it's not just that. I mean, you look at this company here and you can see a company that on a price to book basis, price to book has gone from 4 times to 23 times in the last 4 years. That sounds like this company has gotten massively more expensive when returns have been middling at best and basically flat to down. That doesn't make any sense. But when we look at our uniform accounting data, we can see as valuations haven't massively ramped for this business. This business hasn't gotten massively more expensive than it was before. It's basically trading at the same valuations relative to assets that it has, which makes sense when you think about the company's profitability and growth. And the last thing that we can look at is price relative to the earnings for the company. And we can see here is for the last couple of years, as reported metrics have actually been understating how expensive Oracle is, because of the fact that they've been looking at Oracle from a perspective of looking at it and saying it's a 15 times multiple, and actually it's an 18 times multiple. But the most valuable and important thing that we can see here to help really elucidate how powerful uniform accounting is you can see here, there is clearly a trend in the total shareholder return of this company relative to the market, right? And for those of you who don't know, total shareholder return, is the total capital gains return and dividend return you would have gotten from this company each year. And then the second R, relative, is relative to the market. So we say, is this company outperforming or underperforming the S&P 500 in this case, because it's a US company? When this number is flat, it means it's performing in line with the market. When it's up, it's outperforming the market. When it's down, it's underperforming the market. What we can see here is, there is a very clear relationship here in terms of what's going on with the uniform accounting data and what's happening with the total shareholder return, in a relationship that doesn't match at all with the as reported metrics that seem to make it look like this company is in a secular decline when it's actually a very stable, high return business, and that's what the market's paying up for. So the powerful thing that we can see with uniform accounting is a couple things. The first thing we can see, we are totally misunderstanding how profitable this business is and its growth strategy when we look at as reported metrics. Also, the company's valuation may be different than what we think. Now, neither of those things actually immediately says this is a buy or this is a sell. That really is about what the market's pricing the company to do once we see through the distorted numbers and look at the uniform accounting data. And that's what we can see here when we look at these bars here, which we haven't talked about yet, which are these 2 light blue bars and these 3 white bars here, and the same down here. These 2 light blue bars are what Wall Street sell-side analysts are forecasting Oracle's return on assets to be the next 2 years and its asset growth to be for the next year when we push their estimates through our uniform accounting framework. What's way more important, though, the most important part, are these white bars. These white bars are what the market thinks Oracle is going to do for the next 5 years, based on the fact that the Oracle is a $210 billion market cap and a $72 stock price company. Right? If you want to think that Oracle is going to have its stock price rise over the next couple of years, you need to believe it can do better than these expectations. You need to think that Oracle isn't going to have returns fall to 29%. You need to say, I think returns are going to be 30, 31, 32%, and that growth can stay here or be higher. All right, let's just actually look really quick to see what this could mean. So one, let's say if we think that, right, this is wrong. The market is pricing Oracle to have returns at historic lows for the last 10 years and for relatively subdued growth. The growth we say is probably right, but you know what we think? We think return on assets, all of us here, we're going to say, you know what, let's say that it's going to be the middle of the last cycle, which is around 35%. Well, we can actually find out what Oracle would be worth. And what we can see is if we plug in a 3% asset growth for the company, which looks reasonable, but then we plug in 35% ROA, all of a sudden Oracle isn't worth $70, it's worth $90. It's 25% undervalued. Now, we don't have an opinion one way or the other here at Balance. We're not saying Oracle is worth $95 and the company's undervalued, but what we are saying is this is the power of the Valens Research app and the Uniform Accounting Data and Tool is one, we are having a totally different conversation about the persistency of Oracle's strong returns and its low growth, as opposed to thinking Oracle is shrinking and growing and also has weak declining returns. We're actually modeling the company differently because we're looking at the right data. But more importantly, look at how fast we're able to have that conversation, right? Imagine if we had to build a whole entire DCF model to be able to do this exact same analysis, change all the numbers ourselves, et cetera. The app lets us have all this conversation live, right, with the rest of our team.
Valens Research, the world's leading source for uniform financial analytics.